Thank you for watching. This is Richard with Wisdom Investor. Today we're updating our portfolios for our ETF, dividend paying stocks, and individual stocks. So we're going to go over those. I want to thank you for watching here today. You can get our portfolios at our website, wisdominvestor.com. Go to the Retirement Investor link and scroll down. We also have portfolios for conservative, long-term, aggressive, and also the lazy and dividend-paying portfolio, which is what we're talking about here today. I want to thank you for watching. And dividend-paying portfolios can be an excellent long-term approach to investing. Okay, as you invest, your investment grows not only by the return of the stock or the ETF, which is ETF stands for electronic traded funds. They're very much like mutual funds, only they trade like stocks. And as these investments grow, you earn dividends, which if they are reinvested, they help your investment grow even faster. So they give you a bigger total return. So a good long-term approach is using dividend stocks and dividend ETFs, and we're going to update our list here today. So we're going to start with our ETFs, which is essentially exchange traded funds. Are very much like mutual funds. So here we go. We got our Vanguard high dividend fund here, yielding about 3.17%. Each one of these funds here, we're going to go over about 5 or 6 in the ETFs and maybe 5 or 6 on the stocks. Each one of these have a little bit different flavor to them. This one here is heavy in financial services and healthcare. Okay, you can see the breakdown of the sectors here. So it's had a total return of 13.58%. So let's talk about total return for just a moment. Then we're going to give an example here. Initial investment of $5,000. You're going to reinvest in this ETF, or it could be stock, $200 per month. And you get a total return of 10%. I'm using 10% in this case. So maybe the return of the stock is 6% and has a dividend yield of 4%. Well, let's just say 7% growth on the stock and 3% yield. Just be conservative. And then you're going to invest for 20 years. That grows to $188,000. Okay? So if we invest and let our dividends reinvest, we can grow a nest egg here for retirement. Let's look at the next one here. Is Schwab U.S. Dividend Equity ETF. Had a total return about 16.34%. So the total return is calculated again by the yield, what they're paying amongst the group of stocks that this particular ETF investment is invested in, and then the rest of it is the growth of the actual stock or ETF. So this has actually continued to grow quite well here in 2018. And so it's right back at the top of where we were at the beginning of 2018. And so a little different styles here. Consumer and industrials are the top two. And so it is important to be invested in an uptrend. Now, if you're in a downtrend, that's going to affect your total yield. So we want to be in a good long-term uptrend to really take advantage of these total returns. Here's the next one, S&P 500 high dividend. Dividend yield 4.19, total return 13.98. Its highest sectors are real estate and utilities. And again, it's been growing real nice here. So dollar cost averaging is the best method as of right now. If we get a good buying opportunity, then we can go in with more dollars. iShares core high dividend, 3.62 yield, 9.22%, and energy and healthcare. Now, a good strategy here is to maybe have 2 or 3 of these. Now, the advantage with an ETF, say over a stock, ETF is going to do all the investing for you. If you're using stocks, say 10 or 20 stocks, you have to go out and buy those individual stocks. Okay? There are advantages to the stocks also. We'll talk about that later. Okay, iShares US Preferred ETF, 5.67%. It's been pretty flat on as far as its total return. So it's a little different strategy, pays dividends from preferred stocks. Okay, And we have the Eaton Vance Tax Managed Global Buy. Now this is more aggressive. Okay, you could do a portion of your investments. Of course, any yield that we give here, return, there's no guarantee of the future. Of course, we all know it's going to fluctuate. But this has a dividend yield 9.11. They use a little different strategy. They invest in common stocks and rights call options. Okay, and their top 5 holdings are Apple, Amazon, Microsoft, Facebook, and Alphabet, Google. So this continues to grow higher. Now it's been a little more flat here in 2001 year. So here's where it was the first of the year. So it's been pretty flat. Of course, like most stocks this year, dipped down and now recovered. So it had a total return of 11.74% for the year. So these are our ETF funds that I believe are excellent funds to use. And for like a young investor just starting out, it'd be a great way. If somebody doesn't want to buy out multiple groupings of stocks, then this would be an excellent way to go. So, okay, so we're going to go look at our stocks here. So we're going to start with AT&T. We have AT&T here. Has a dividend yield of 5.98%. When looking at stocks, I listed some categories here that are good to be aware of. All these stocks that I've listed are stocks that have had a consistent return over at least 10 years. Now, yes, you can always go out and find a stock that has a 20% yield, but then next year it's 0. So we're talking about consistently earning dividends on these stocks here. And of course, the other thing too, as I've already mentioned, we want to be in an uptrending market. Now we're seeing AT&T here overall. It's in a downtrending market right now, lower lows, lower highs. And so it's actually total return down 9.19%. So I would want to see some kind of a breakout to the upside on this before I invest, or we want to reach a level here where this is going to stop moving lower before I want to buy on this. Okay, the other telecommunications fund I do like, I didn't chart it here today, Verizon's. Now it has a total return of 12.65%. It's got a nice chart going up. The yield is lower than AT&T, okay, 4.51%. Now, always getting just the looking at this as from the highest yields, not always the best way to look at it, although you do want to have a return, a good yield on your stock. But you've got to take in place what's the growth of the stock looking like in addition to the yield. Southern Company. Let me just back up here too. This is the telecommunications area. So each one of these 5 or 6 stocks we're going to look at are different areas of where they specialize in as far as their company. This is next company here is Southern Company, a telecommunication. Let's see, Southern Company is utilities. Okay, 16-year dividend growth, 5.5% yield, and now it's been down on the total return down 6.47%. So it's off its highs on the highs, but it's overall it has been a good solid stock. So it doesn't mean that there can be times that it goes down. We just want to make sure we're still trending upwards. Okay, this is still trending upwards, but the nice thing is when it's lower, you buy shares at a lower price, so you buy more shares. You're actually getting more shares. So that's Southern Company. Then we have Exxon here, energy stock. This is in oil and gas. Dividend yield 3.86%. Total yield 7.59%. Dividend growth 35 years. So energy, I think, is going to be a player here in the next year or so. Even though this is at the highs, that's not why I'm saying that's why it's the highs. I would rather buy this down here. But dollar cost averaging is a good method. Dollar cost averaging would be a little bit each month. So one month you're buying a little higher, maybe next month you're buying a little lower, and it averages out. But I think the energy stocks have a chance here in the next 12 months to do quite well. So I'm going to be watching this real close myself. I'd like to find this a little lower. It's looking like it has a topping pattern here. It may not want to go higher right now, but I'd definitely like to be watching the energy shares here. Cardinal Health gives us some healthcare services. Now this stock has been moving down. Okay, total return minus 16.5%. Dividend yield 3.53. Typically 3 to 4% average on your dividend yields can be acceptable. Say 3 to 5%. Okay. Now I wouldn't be in this one here right now. I think it's a good company, it's a good stock, but when it starts to turn around, I think this can give some diversification. Healthcare services. We have Procter & Gamble. Dividend growth 61 years. So some of these are good, solid companies, not your Amazon, Google, Facebook, high-flying tech stocks. Typically, they don't have as high a yield. Okay, those aren't. But this is 3.45%. It's been there for 61 years. A lot of folks who have a lot of dollars to invest, and they want a company that's going to be around, and they don't want to have to worry about it. This is a company, Procter & Gamble, that's definitely going to be around. General Mills here is another company, long-term company. Package and process products. Now it's been down too. Total return down 13.29, pays a higher yield, 4.57%. So when I could see that this would be starting to turn back up and getting back into this nice move higher, I would definitely think that would be a reasonably stock to buy. Now I also have a list here of some additional stocks to consider. I didn't have time to put every one of these on the charts, but these are all long-term winners over time, different areas of management business that they do, but these are all I think very well. But I picked these 6 here are going to be ones I'm going to be watching here, and especially the energy here is I'm going to pay a lot of attention to that here in the next few months. Okay, leave your comments on what you are investing in for stocks and dividends. Give us some input on where you're going to be investing or already investing, and maybe some of your strategies, because definitely having a long-term strategy, investing in dividend stocks or ETFs can definitely pay off for you in the long run. Well, thank you for watching.